Hello and welcome back to our next session. Rödl and Partner presents The Lighthouse, talks with our India experts. In this episode, we attempt to briefly decode the taxation of permanent establishments in India, the consequences of establishing a PE in India, and finally, how to manage PE risks in India. In today's session, we have with us Gaurav Khanna. Gaurav is a qualified chartered accountant and heads the advisory practice for Rödl and Partner, Mumbai. Gaurav is an international tax expert and has close to 14 years of experience in advising multinational clients on tax and regulatory implications of business transactions. Welcome, Gaurav.
Thank you, Anishi. It's my pleasure to be here today.
Thank you so much. So, Gaurav, let's start today's session by explaining our viewers the topic for the day.
Okay, the topic for today is permanent establishment. The concept of permanent establishment is a highly contentious topic in international tax. It's often referred to as PE. As multinationals grow their operations beyond the boundaries of their home country, it becomes extremely important to manage the complexity of their tax affairs. Let me give you an example. Imagine a situation where a German company intends to do business in India. It can do so in two ways. One, it can simply set up a subsidiary company which can then take care of the local operations in India. However, let's say it is awarded a contract by an Indian entity. Now it can execute that contract on a turnkey basis, either by setting up a branch office or a project office in India, or it can simply send its employees to India. Furthermore, it can even engage a local subcontractor to execute the onshore work in India while the offshore work is taken care of abroad. Now in all these situations, the moot question that arises is, owing to whatever business activities this German company is carrying out in India, whether it should be subject to tax on its business profits earned from its projects in India. This is where the concept of permanent establishment comes into play. As the name suggests, permanent establishment or PE is some sort of a permanent degree of presence of a foreign enterprise in India, signifying a virtual extension of the foreign enterprise in India. It's only a fictional concept which is created for tax purposes, which allows the source state to tax the business profits of the foreign enterprise in India. Therefore, in my example, unless the German company has a PE in India, India will not get the right to tax its business profits.
So, you're implying that any income earned by a foreign company would be taxable in India only if it has a PE in India?
That's a very good question, Anushi, and I am glad that you asked this question. So, the simple answer is no. There are several income streams that foreign companies usually earn from business transactions with Indian entities, like fees for technical services, royalty incomes, interest income, etc. Now, all these incomes can be subjected to tax independently also, irrespective of the fact that whether a foreign enterprise has a PE in India or not. Let me give you another example. Say an Indian company engages a Swiss multinational for providing some technical consultancy services. And these services are rendered by the Swiss company from Switzerland only, that is, from outside India. Now, in this case, though the Swiss company is not likely to have a PE in India, the income that it earns from providing these services would still be subjected to tax in India, and typically the rate would be 10% on gross basis, because that's a typical rate for taxing fees for technical services. However, let's continue with the same example. Assume that the same services are rendered at a customer site on ground in India. Now, in such a case, the taxability of such income could be different depending on whether the Swiss company has a PE in India on account of such services being performed on ground. In case a PE is constituted in India, the taxation of income suffers two different treatments. One, the rate of tax changes from 10% to some other rate. What is that rate and how is that arrived? We'll discuss it. Secondly, the applicable tax rate is applied on the net income of the PE, that is the profits of the PE, and not on the gross amount of income. Therefore, it becomes extremely important to determine whether a foreign company has a permanent establishment in India.
So, got it, Gaurav. So, based on your experience on such cross-border projects, can you please tell our viewers some typical scenarios that may trigger permanent establishment risks in India?
Sure, Anushi. See, considering the way the businesses can be undertaken these days, especially with the aid of technology, with technology being all pervasive, it is possible to have a permanent business presence abroad beyond the conventional brick and mortar physical presence. However, For the sake of our discussion today, we will focus on 3 typical ways of constituting a PE in India. First up is a fixed place PE. This is the most common type of PE which is usually found in India as well as universally. As a general rule, a foreign company may constitute a PE in India if it has a fixed place of business at its disposal through which its business is wholly or partly carried out. Now, each and every word in this definition has a very wide connotation. For instance, a place of business can be a customer premise, can be a facility, or it can also be a machinery used by a foreign enterprise to conduct its business in India. However, what is important is that the foreign company should have the right to use this place of business, and the place of business should be at its disposal. That too for a reasonable period of time, generally 6 months. Thus, an isolated business activity undertaken by a foreign company in India would not typically lead to a PE risk in India. Having said that, let's make it a little interesting. There have been certain judicial precedents in the past wherein Indian courts have held that even a lesser duration of presence in India, owing to specific facts of the case, could be sufficient to constitute a PE in India. Next up, let's discuss construction PE. Now, this includes typically a building site or a construction or installation or assembly project or any supervisory activity which is carried out in connection with those projects. Now, if such activity is being undertaken in India beyond a specified time threshold which is prescribed in the tax treaties, and that time threshold is typically either 4 months or 6 months, then it could lead to a construction PE in India. Moving on, let's discuss another important type of PE, which is agency PE. Now, many a times you would have seen that foreign companies appoint agents in India to market or promote their products or generate leads from Indian customers. In that situation, there could be a potential agency PE exposure for a foreign company in India if the agent is perceived as carrying on the business of the foreign enterprise in India. Now, I'm not saying that every agency arrangement would lead to an agency PE risk in India. Nonetheless, agency arrangements should be carefully reviewed and structured in order to avoid or mitigate any adverse tax exposures in India. In addition to the P's that I highlighted, fixed place PE, agency PE, construction PE, there could be several other scenarios like secondment of employees to Indian subsidiaries, or where the Indian subsidiaries are carrying on the business of the foreign company under a direction and supervision of the foreign company, that could lead to a PE in India. Thus, permanent establishment is a completely fact-driven exercise, and it depends on the facts of each case, and we need to assess the facts very meticulously to understand if there is a PE risk for a foreign company in India.
Thanks, Gaurav. That was explained very well. Well, can you also tell our viewers what is the rate of tax applicable for a PE in India, and what are the consequences for establishing a PE in India?
Sure, Anusha. The applicable tax rate in case of foreign companies is 40% plus applicable surcharge and cess. This rate is, however, applied on the net income, that is, profits of the PE. Now, since this is applicable on the net income of the PE, foreign companies usually approach the Indian revenue authorities to obtain a withholding tax order here. This order is then passed on to the Indian customers, who will then apply the withholding tax rate as prescribed in the order while making payments to the foreign company. This is very crucial because in case where such withholding tax order is not obtained, the Indian customer would actually be compelled to withhold tax at a very high rate of 40%, which could potentially make the project commercially untenable for foreign companies in India. Now, as far as compliances are concerned, once a foreign entity constitutes a PE in India, it is required to obtain applicable tax registration, maintain books of accounts of the PE in India, get those accounts audited, undertake tax filings and transfer pricing compliances in India. In addition, due to possible longer duration stay of employees in India, their own personal tax and social security implications may need to be looked into.
So what is the piece of advice you would like to pass on to our viewers to enable them to manage or to mitigate PE risks in India?
Well, in my view, having a permanent establishment in India is not a big problem per se, but failing to understand the implications in case a PE is constituted in India is undoubtedly risky. Therefore, in case a foreign company perceives a P risk in India, it should right away seek professional advice and carry out a thorough review of its proposed and ongoing business activities, especially the customer contract. Now, finally, in a situation where due to the nature of work and the complexity of work, etc. being undertaken, in case a P is inevitable, then also there is no need to panic. Sure, having a P in India would entail some tax costs and compliance burden, but it could also offer some strategic business advantages, provided proper tax review is undertaken and commercials are pre-agreed and aligned with the Indian customer, taking into consideration various administrative and compliance costs that would be required to be incurred to manage a PE in India.
Great. This was a wonderful session, Gaurav, and I'm sure our viewers would love to seek professional advice from you.
Thanks a lot, Anushri. It's my pleasure to be here today. I would be happy to take any queries or undertake any discussion in case any foreign company is looking to do business in India.
Gaurav's contact details are given in the bio of this video. With that, we conclude our today's session. Dear viewers, we would be delighted to remain connected with you via our series Rödl & Partner presents The Lighthouse, talks with our India experts with many more informative videos. Until then, please be safe, grow your business and play by the rules.